Hi, thank you for again booking a call with Swanson Reserve Capital. My name is Craig Swanson. I am the founder and managing partner of our Multi-Strategy Hedge Fund. I'm excited today to walk you through, prior to the call, just to show you a little bit more about our offering and things that we've actually invested in. These are our most recent allocations done in late November. Some of them are really exciting, and I want to just talk about it for a second. So say if you have a financial advisor today, or you have invested in a fund before, what's going to make us different, right? Most people we work with are really smart and savvy, so we want you to ask us questions. Please, when you get on a call, have your questions ready. We're ready to help walk you through this entire process, soup to nuts. Nothing will be left out, and make you comfortable to be a partner with us on this journey going forward. So take a step back. I have been investing in structured products for several years. So much so that I have actually done things, and we can talk about this on our call. I used to be a real estate investor, and I had equity in my home. Because that equity is sitting in there dead and not working for me, I took an equity line of credit to invest in structured notes. And that's what we're going to talk about today. This is what our fund focuses on. These are three different types, so to speak, that I'm going to walk through. Technically, they're all growth notes. However, I wanted to talk about the difference in investing in this versus your traditional index fund versus what a financial advisor is going to put you in the traditional 60% equities, 40% bonds. What you'll see here with us is that we have very deep downside protection. So we're capital preservation first. This particular note I want to walk through is a note issued by BNP Paribas. The actual investment is backed by the good faith and credit of this bank. This underlier, so this is a bond essentially that tracks the S&P 500 FP, which is an excess return index. So it basically takes the risk-free rate and it subtracts that by the inflation rate. And so it more than less, about 2% tracks the S&P 500. This is a very interesting note in that all that needs to occur, and what attracted us to it, is it's a 5-year term. We definitely don't expect that to go up 5 years. It's actually longer than our traditional investment of 3, but it had a 35% barrier on the price, meaning from the trade price you get in, there's 35% protection from the time in which you buy. All that needs to occur on this investment, which is, generally most years the S&P has been positive. If it goes up 1 penny, we'll make 28% on the amount invested in this note. The protection, again, we covered, is 35%. If it doesn't happen, which is even more exciting in my opinion, because I like long-term, it's okay if I don't get my 28% in year 1. This will go out the duration of the note, and I will get 200% performance of the S&P future excess return. So I'm already guaranteeing, based on what anyone else is doing, investing in the same day and the same price, I'm already going to make double what they're going to make. And so that's what gives us the attraction to certain products and vehicles like this, is we have that edge. We also are pricing all these banks against each other to give us the best yields, the best performance participations. It's really, really interesting and unique. And this is why I moved away from my role at Fidelity, is we weren't doing anything in this space. And it's truly fascinating. I have a heavy amount of skin in the game. I'd say over 40 to 50% of my net worth is just in structured products. And then the other is in my other share class, which is equities, quantitative equities. But another example, same premise. Note is backed by Morgan Stanley. It tracks Tesla. Tesla's been doing very well. 3-year term, no call for 1 year. There's a 45% barrier, so it can go down 45%. Those are really bad for, and you will still be protected all the way up dollar for dollar if it drops 45%. Over 3 years. If it goes up 1 penny, we make 30.25. The call is done annually. So that means each year, this is gonna be a step up. So if it doesn't happen year 1, doesn't go up 1 penny, we don't make it. Goes out year 2, we're going to make 60.5%. Year 3, 90.75%, and so on and so forth. The last one, which is arguably the most compelling based on the risk reward, there are notes that in our portfolio at least 10% allocation called principal protected notes. These notes, and every financial person is going to say you're not able to lose money, it's risk free. This is as close to as risk free as you can get, and I'm going to explain why. There's always some risk in investing. Here's your risk. BNP Paribas does not follow through on their good faith and credit against this note. You're going to take issue risk off the bank. So the bank needs to technically go out of business and not fulfill its debt obligation. That rarely, if any, if I could give you one example, it'd be the Lehman Brothers back in 2008 times. And banking regulations are so much different now. That has never occurred in over the decade that we've been doing this. Can't lose money on principal protected notes unless that occurs and they go out of business. It's going to track Nvidia, Tesla, and Amazon full participation, meaning you're going to get whatever the lesser performing one is. You're going to get that equities market performance plus 1.385 the upside, and it's uncapped. This is one that I haven't seen. These are really, really rare, and we were just pretty lucky, honestly, to get into a note like this, because essentially anyone else that's investing in the market is taking market risk on these equities. They can go down. All of these could go down 90%. We will not have lost a thing. They could go down 99%. We will not have lost any money. It's principal protected. So we're just able to ultimately have a free play against these three equities, capture not only the lesser of performing, so it could be any of these, we're going to get a multiplier of 1.385 better than everyone else, and then we're not taking risk on the downside unless BNP Paribas defaults, goes out of business. So if you could see the value here, this is definitely something to be excited about. Happy to dive into this a little bit further, but this is what we do at Swanson Reserve Capital. Thank you for your time, thank you for your attention, and look forward to speaking with you soon.